I think we're good. Let's go ahead and get started if everybody's okay. Let's end the poll. And so it looks like 57, almost 60% of everybody on the call are new to flipping, ready to do their first. And we've got a couple of people with some serious experience, 7 to 10 flips and more than 10. At that level, that's considered an expert. You've had just about everything go wrong that can go wrong after about 10, right?
Well, that's good. That gives us a nice diverse group to start with today.
Yeah.
And chime in when we ask questions if you have some experience and want to share.
Let me get the poll here out of the way. My name is Lee Walsh. With me is Lila Amelbert. Together we're Radar Mortgage, and we do fix and flip financing. We do long-term rental property financing, commercial lending, large 1 to 30 unit apartment lending. So this meetup, this group is for going over fix and flip financing terminology. A lot of people that we've worked with that have that experience of 5, 10, 15 deals, a lot of people don't use our type of financing and aren't that familiar with it. And what we thought we would put together is a workshop to teach you how lenders think. When we look at a deal, what are the questions we're asking in our heads about the deal? We get a lot of calls, and the first thing somebody will start telling me is about the neighborhood, the neighbors, how well the lawn is upkept, the school district. Although some of those things have an impact on the value of the property, a lot of them really don't. And so this is designed to give you the tools that when you're talking to somebody like us, either us or somebody in our space, that you're talking the language that we're looking for. That helps the lender you're talking to understand the deal better. It helps you understand how a lender is going to look at your deal before you start talking to them. The things that they really want to hear, the things that are important to help you get that financing. And I will tell you that both Lila and I have a lot of calls every day with people that they've never had a flip, they want to learn about it, to people doing 10, 20 flips in their lifetime. The more you know about how we think about it, the better you're able to tell us about your project and what you want to do. And that's how you get it funded. And so this is hopefully to arm you with some knowledge and skill that I think the average flipper does not have. Well, we had 2 polls. It's not going to let me pop up the second one. And, the second one was just how do you finance your deals? And, do you use your own money? Do you have friends and family or credit cards that you fund your deals with? Do you have connections with private investors that may lend you money? Do you use more institutional type leverage lenders like us? If you would, you guys that have done the ones of you that have already done some flips, give us some input there. Kind of tell us how you financed your deals in the past. If you want, just go ahead and unmute yourself. I think that'd be some good information to know.
All right. Am I audible, Joel?
Yes.
Okay, great. Hi, my name is Stephen Campion. I entered in a number for my name on here. Sorry about that. So I'm one of the 7 to 10 guys. I'm actually working on selling my 8th, and I'm about to close on my 9th tomorrow. It will be my 9th tomorrow.
Excellent.
So yeah, your comment about everything that can go wrong has gone wrong is spot on. So I've funded these deals with 3 different lenders. One is a 100% kind of private money guy. He's fairly expensive on the rates, but being able to fund 100% is valuable. So he's done most of my flips, and then some local hard money lenders have done up to 85% purchase and repair, with a friend of mine providing the gap capital, just people I know directly or personally. I've noticed that a lot of those hard money guys have either closed up shop or changed their numbers to be much more conservative after COVID.
Yeah.
I've had
Yeah.
a hard time finding any hard money lenders that will do more than 65% purchase and repair at this point. Although I expect as the world goes back to normal, that number will go back to what it was. But as of right now, I'm part of the reason I'm here, actually, is I'm hoping to get in contact with some new hard money lenders. So,
Well, great. Thank you for that. Edward, you've done some flips, haven't you?
Yes, I have actually a private lender that I use, and I've used it for a number of flips here in the Orlando area. So yeah, that's what I've been using so far. Other than that, I'm looking for other, to have other options, I should say.
And am I right that that is probably when you get started, when you were new at this and trying to get your first flips going, finding that funding was probably not the easiest part of the project, right?
The first two flips surprisingly came really easy. It was after that after that it became harder, because then they demanded more, so I started finding more. But I guess my first two flips, they just fell on my lap. But yeah, after that it became a lot harder. Yeah, for sure.
Yeah. Is everybody here a member of CFRI?
Yes.
For those of you that aren't familiar with CFRI, Central Florida Real Estate Investment Group is part of a national group of real estate investment associations called RIA, National RIA. Central Florida, we're lucky here in our market, this is one of the biggest, most successful groups in the country involved with the national group. I belong to 4 different RIAs, Miami-Dade, Broward, Central Florida, and one in Alabama. The one here has been going for probably close to 2 decades at least. And you'll find a lot of people there for help, especially when you're new and trying to learn and trying to get experience and find people to give you information. Our company is a sponsor of CFRI, and you can find them at cfri.net. It's a minimal cost to join. They have meetings almost every week somewhere in Central Florida. One of the things that this COVID crisis has done is it's pushed us all to the internet. And we did the same workshop for a West Volusia group last night. A lot of CFRI members are in that group too. They're a separate group, West Volusia Real Estate Investment Group. You can find them on Facebook. That was one of the things they were talking about, is the amount of information they learned and gained by being CFRI members. So we sponsor it. When they were doing in-person meetings, we're always at them. We always have a booth there. And you'll find, just like in any group, you'll find somebody trying to sell you a bill of goods. That's everywhere you go, no matter where you go. But you will find far more helpful, knowledgeable people at CFRI. That's been my experience there. So I urge you all, especially if you're new to this, whether it's flipping, whether it is buying long-term to keep for investment property to build equity, apartment complexes. There are people there that are experts in manufactured homes. You name it, there's somebody doing it there, or somebody to give you some information on doing it. Let's go ahead and get started. We'll talk about how to answer the kind of questions that a lender is going to ask you and the real information they're looking for. We'll teach you some of the tricks you can learn to package your flip to get a lender's attention and to get an approval. And most important, the language that we use. What are the terms that we think in? If you're new to astronomy, you're going to learn a whole new language. You'll find a lot of the terms that we'll use you are familiar with, but how we use them, maybe not. And then we're going to talk a lot about the power of financial leverage in making money flipping. And I think the takeaway from that is, with everything going on with COVID, it has made it harder to find great deals. Prices have gone up, interest rates have gone up. As we were discussing just a bit ago before we got started, the amount lenders, either private or institutional, want to loan on a deal has gotten tighter. So the power of financial leverage will help you increase your return on investment. And we look at ROI a very simple way. How much did you put in? How much did you get out? Cash on cash. We're not worried about long-term depreciation or any of those other things. First, I got to do to cover the legal aspect of it. Bear with me here while I go through this disclaimer. This information is provided in this presentation and accompanying material is for informational purposes only. It should not be considered legal or financial advice. You should consult with an attorney or another professional to determine what would be best for your particular needs. Content contained on or made available through our website, in person, or webinar is not intended to and does not constitute legal advice or investment advice, and no client-attorney relationship is formed. Please use the information that we provide to you at your own risk. With that said, in this meeting, our goal is that you walk away with at least one thing that you see as value at the end of the meetup. And if you've learned at least that one thing, then we feel we've done something to help everybody move forward. Lila, you want to kind of set us up here?
Yeah, sure. So we're going to go over the flip and fix financing. We're going to talk about what a fix and flip is. We're going to go over the lending terms. We're also going to present, Lee's going to present a deal option with 3 different options for financing and show you the breakdown and show you how the leverage on each option, okay, and your return on investment. Okay, so for those of you who don't know, a fix and flip, okay, loan is basically short-term. It's a short-term loan to purchase and renovate a property with the intention of selling or refinancing when completed, okay? So it's a short bridge loan. It usually is from anywhere from 9 to 12 months. We mostly state that it's about a 9-month loan. It can be extended to 12 months, okay? It's interest only. There's no prepayment penalty. It's up to 90% of the cost based on experience, and you can close in 10 to 15 days. Our rates range anywhere from 8 to 11.5%, and that's going to be dictated based on credit score, and experience is going to dictate some of that, okay? Lee's going to do the lending terms now. He's going to go over that portion.
So for the terms, one of the first worksheets that we push to you is, basically a fix and flip financing definitions. So there are 10 basic terms. There's really more than 10, but for the purpose of this, to talk about financing and how a lender is going to look at your deal, there are 10 basic terms that if you have these terms down and know how they relate to the deal you're talking about, you're way ahead of the game, because it will cut down on a lot of the back and forth with whoever you're trying to get a price or a quote from. These are all things that before a lender can give you a quote, these are all things they're going to want to know. And so if you have the worksheet, what we're going to do is we're going to give you the definition and then match it up with the correct term. So the 10 terms that we're going to cover, here they are, and we'll start with the first one here. The term is return on investment, or what we call ROI. And our definition of ROI is a really simple one. It's cash on cash. If you put in $1, did you get that $1 back? That's breaking even. And if you got $1.25, you made 25 cents on that $1. That's a 25% return. You made your $1 back and made an additional 25 cents. When we talk ROI, that's the term we're using and how we're figuring it. So the return on investment is the ratio between profit and the cost of investment. A higher ROI means the investment's gain is favorable to its cost. In other words, you're making more money. The higher the ROI, the more money you've made on the deal. Leverage, which you'll hear us talk about throughout this workshop. Leverage is, I guess the Investopedia interpretation is the use of debt, borrowed funds to amplify return from an investment or project, used to multiply buying power in the market. Here's a good example. You buy a home for $100,000, you finance 80% of it, which means you put $20,000 into that deal. The property is going to appreciate, and say it appreciates, we have a good year, it appreciates 5%. You didn't gain appreciation on the $20,000 you invested in it. You gain appreciation on the full value of the property. So you used your leverage, your financial leverage, to gain a $5,000 appreciation on that $100,000 property, but you didn't put $100,000 in to make that 5. That would be a 5% return. Instead, you put 20 in. So you now made a 25% return on cash investment. That's the basic definition of how leverage works in finance. And we'll show you how on a flip, on a short term, because a fix and flip loan is anywhere from a 3 to 9 to 12 month term. It's however long it takes you to close on the home you bought, renovate it, and put it up for sale, and close on it and get your money back. Acquisition price, that's simply the purchase price, the cost to buy the property as is. We're not talking about what it's going to be worth when you're done. We're simply saying this is what it's going to take to buy it. Then you have improvement costs. We're going to buy it, and then you got to put money into it to improve it. And that's the cost to improve the property. Here's a term I think most people know, but they might not be sure on how we use it. And in the discussion we had before we get started, you heard this come up, the after repair value, the ARV. What's that property going to be worth after you've purchased it and improved it? The ARV value, if you're buying a home as is and it doesn't need repair, it's going to be the fair market value, the appraised value. Loan to cost, the basic definition of that is how much will the lender lend you against whatever that cost is, whether it's the total cost, whether it's the amount to buy it, or whether it's the amount to renovate it. Again, this came up a bit in the preliminary conversation, and we'll cover that conversation in detail as we go through here. But sometimes you'll hear a lender say, yeah, we'll give you 100% to do the deal. There's part of the sentence that they didn't finish. And we'll get to that one. That's going to be the third one down, the ARV cap. So out of the 4 we went through, now we're going to talk about the caps on that. And caps are basically the limits. For each of those 4 terms we went over, there's a limit that we as a lender will do. And it varies based on the deal. It could be impacted by your credit, your experience, or the scope of the deal. Is it a light renovation, or are we going to add 1,000 square feet or go up a story? Is it light, medium, or heavy renovation? All those things are important when you get to the caps. So an acquisition cap is pretty much what it sounds like. It's the amount, the maximum that we would lend to buy the property. We won't always give you 100% to buy it or 100% to renovate it. The improvement cap is that same thing. It's the cap that we would put on it as a lender that we would contribute towards the improvements. The maximum a lender will commit to improve the property. The ARV cap, this is the most important one. It's the maximum a lender will commit to the project as a percentage of the after repair value. And we were talking about that a bit earlier, where that's been cut since COVID. A lot of the private money people that would have gone to 70% previously are now down to 60, 65. And when we talked previously about the amount that we would lend to purchase and the amount that we would lend to renovate, there's a factor that I would bet when most people talk to a lender like us, this is the last thing for some reason they want to discuss with you. I think it's where they should start first. I might say, hey, I'll do 90% to buy it and I'll do 100% of your renovation. And then very quietly, well, I've got an ARV cap of 60. And what that means is no matter what that first math comes to, we're going to take what the property is going to be worth when it's done and times it by 60%. And that's going to be the most that lender's going to go, no matter what that 100% of renovation and purchase says. And so it's a cap, a limitation. And anytime you talk to a lender, when they start talking about the other things that they're going to do on the project for you, I think where you should start with them is what's your ARV cap? I was telling this story at a previous meetup about 6 months ago. A good friend of mine I've known for over 20 years is in the same lending space that we're in. He's got a successful national company, and he came out with a new program, and the program was 100% financing on your flips. And that's all they say. You know, you got a flip, we'll do 100%. We'll contribute 100% of everything. And he wanted me to merge my company with his, and he was putting a hard sell on me about all the benefits. And the first thing I said to him is, what's your ARV cap? You know, is it 100%? Or, you know, if we know that the property when it's done is going to be worth X, will you loan me 100% to get it fixed? And he said, well, no, my ARV cap is 60%. And that was actually a much worse deal than we do. But on the advertising and the marketing he does, it sounds wonderful. You know, so what's that old saying? The big print giveth and the fine print taketh away. That's the fine print. Always ask that question. Another cap, and it could be, some people will kind of call this the same as ARV cap, loan to cost cap. It really is the same thing. How much we'll lend against the cost. And some people don't call it an ARV cap, they call it a loan to cost cap. And the way we use it is the maximum we'll lend on any portion of the project. How much will we lend you to buy the home, and how much will we lend you to renovate the home, as long as we do not exceed our ARV cap. And we're going to take a deal a little bit later. We're going to take the same deal, the same numbers, and we're going to break that down, doing it with your own money, doing it with a private investor partner, and then using our type of leverage, of financial leverage. And we'll cover this a lot on on the loan to cost caps and the ARV caps. So if you had the worksheet and you were filling it out, this is what the right answers would be on it. The cost to improve the property, number one, is improvement caps. Number two, the maximum a lender will commit to buy the property as is your acquisition cap. Number three, the maximum a lender will lend on any single portion of the project as a percentage is your loan to cost cap. The maximum will commit to the project as a percentage of ARV is your ARV cap. The ratio between the profit and the cost of investment is your return on investment, your ROI. The cost to purchase the property as is your purchase acquisition price. The fair market value after improvements is your ARV, your after repair value. The amount a lender will contribute to any single portion of the project is your loan to cost. And the amount the lender will contribute to the deal to improve the property is your improvement cap. And then leverage is the use of borrowed debt to amplify or increase your return. And, you know, I know that's a whole lot of terms to throw at you. And if we were just going to do that and then end the call, I probably left you really confused, especially if you're new. but we're giving you these terms so then we can take and show you some deals and then show you how we're using these terms in a real structured deal. Hang on here, there we go. Any questions about this part on the terms and the definitions? And if you want, just unmute yourself if you have a question. You can also put them in chat if you are on a phone and in a place where you're on earpiece or something. Okay, let's move on to the next section. And now what we're going to do here is we're going to take a deal. We're going to spend $140,000 to buy a home. We're going to take $40,000 to renovate it. So our acquisition is going to be $140,000. Our cost to renovate, to improve, is going to be $40,000. We're going to show that first as using your own money, using cash. Secondly, we're going to show the same deal using a partner or a private investor. And then the third way we're going to break down that same deal is using our type of financial leverage. And I will say this going in, is there's positives and negatives about all of them, all three. There's times when cash is the best, simplest way. There's times when a partner investor is the best way. And there's times when our method of financing is the best way for you. And we believe by helping you understand this better, teaching you more about the concepts of how a lender looks at it, you'll be able to make those decisions better, we hope. So the first one is using your own money. There's not a lot of math here. And again, by the way, we'll do all the math for you if you're following along with the worksheets. We're going to just fill in the blanks. And when we're done, we're going to figure out what the return on investment is this way, what the ARV is, what your cost to do the deal is, and what your gross profit hopefully will be if you're right about your ARV. So cash your money. We're going to buy the home for $140,000, and we estimate on that deal you're probably, no matter how you try to avoid it, you're going to have closing costs. We estimate about $5,500 in closing costs. You have intangible tax, sales tax, property tax, title insurance. I would never, if I have $1 million bucks in the bank right now and I was going to buy a property today, I would never do one without getting an appraisal or at least a BPO, a broker's price opinion. So you're going to have to spend money to buy a home, period, even with your own money. $40,000 to improve it. Up here in the upper right, we're setting, there's that ARV that we talked about, the after repair value. We believe when we're done improving this, it's going to be worth $235,000, and that's going to be what we intend to sell it for. There's a set of fees on every flip that, especially when you're new, if you've done at least one flip, you know this fee is there. It's when you're ready to sell the property, you have costs that you incur again. You're going to have closing costs as a seller. You may have to contribute some of the closing costs to the buyer. And so you have, if you're using a real estate agent, if you're not lucky enough to be the listing and the selling agent and be a licensed realtor besides the flipper, you're going to have real estate fees. So we estimate on a deal about that size, you're going to have about $12,500 when you sell the home in real estate and other fees that you incur when you sell the home. So that's going to put your total cash investment on that deal at $198,000. You're going to sell it for $235,000. That's not bad math. You're going to pull out $34,000 in profit on $198,000 cash investment. That's just under a 20% return on investment. You put out $198,000. Well, you really didn't put out $198,000. I'm sorry, because of the $12,500. That's not cash out of your pocket. Let me back up there a little bit. On the real estate fees, when you sell it, it is a cost. but it's not a cost you're going to pay to get the deal done. It's a cost that you're going to deduct from your gross profit. So in that respect, it is a cost because that's 12.5 you didn't make. So on that deal, you'd walk away with 34,000, get somewhere around 20% return on investment. That's not a bad return. If it took you 3 to 4 months to do the deal, you've made $8 to $10, $11,000 a month while you're doing the deal. You get your payoff when you sell the home. And there are a lot of people that do these deals every day just like this. So we're going to take that same deal now and we're going to look at it a different way. We're going to use a private investor slash partner. And this part is a little vague because it's hard to nail this down exactly. Anybody who's used private money or a private investor or a partner in that scope will tell you that it's the Wild West. It's whatever you and that investor can agree on. Here, I grabbed that, Lila. And so we've taken 7 or 8 deals that we've looked at that had private money on them as an investor and kind of averaged it out on a deal this size. So these numbers may not be exact, but I bet we're in the ballpark and I bet you've seen deals done this way. But with that said, it can be worse, it can be better. If you've got a great investor that you've worked with and they love you and you've made them money every time, you'll probably get better terms than what we're going to talk about. If you're new and you don't have a track record and they don't know you and they're leery, it may be worse than what we go over here. But this, I think, will be kind of down the center of the lane. So we have that same 140 purchase price, acquisition price, and we have the same ARV value after repair value of 235. Now that we've borrowed money, the partner has agreed to contribute the purchase price of 140 at 12% interest. I've seen higher interest recently than that from private investors, and a little lower. On this deal, the investor is going to give you the 140 to buy it, but you're going to contribute the closing costs, the interest, and the improvement costs. So you're going to bear the other costs in line there. So your improvements, remember, were 40,000. When you sell it, you're going to have those selling fees that we talked about of 12.5. That's going to increase your total cost a little bit, up to 206,400. You still have the same sale price. You got the 235 ARV sales price. So your cash investment in the deal is going to be 53.9. The closing costs and the interest on the deal. And then you're going to have the 12.5 that's going to kind of have to come off the sales price that neither you or your partner private money investor is going to get. That's going to have to come off the sales price. So that's going to leave a gross return there of 28.6. If you have to split that deal, split the profit with the partner, and I see that deal a lot. I'll loan you the money, you take care of the renovations, and we'll split the profit. If you had to split the deal, you're going to walk away with only 14.3. That's a lot less than the other deal way we talked about, but you put a whole lot less of your money in it. You didn't put the full amount in, the full 190-some thousand to make the profit. You have 53.9 in it instead of 190-something. So if you're splitting that profit with the private money investor, you're making about a little over a 25% return. If you just got a straight interest deal, the investor says, hey, I'll give you the 140 to buy it. You're paying 12% interest during the deal. You take care of the improvements and all the other costs, and you keep the profit. Well, then you'd make close to a 50% return. And I think with private money and partners, it's somewhere in there. It's not exactly as we laid out, but I bet we're pretty close. And again, as I say, the minute you start working with a private investor, it's the Wild West. It's whatever you can work out. It's negotiable. Uh, so that is with a partner private investor, and some of the average deals we've seen them done this way. So the third way we're going to look at this same deal is using more of an institutional type investor like us. What we call using the power of financial leverage to make more on the same deal. So here we are again. We're buying that home. We're paying 140. We're putting 40 in it to improve it. That's a total of 180. Remember, what is the ARV value? It's 235. And now some of the other terms we went over are going to come into play here. And that first one I said was the most important one. Anytime you're talking to a lender is the ARV cap. On this deal, the ARV cap is 75%, meaning that no matter how much we said we would put towards purchasing the property, and no matter how much we said we would put towards improving the property, the maximum we would contribute to that deal is $176,250. That's 75% of the after repair value. And that's our current ARV cap that we have as our company. And I think we're right now some of the highest ARV caps, which means it's the best ARV cap out there right now. We're not the only people in the world with 75%, but most people right now are at 70 or 65. So as the lender on this deal, here's how we would participate in the deal with you. We would cover 90% of the purchase price. We would cover 100% of your improvements. So on the purchase, we're going to bring 126 to the table, and we'll be prepared to advance you, contribute 40,000 for the improvements. That's 100% of the estimated improvements. So far we'll put in 166 of that deal. And so have we hit the ARV cap? No. And right there is where I'm telling you, the big print giveth and the fine print taketh away. If the investor is not, and you have not discussed what their ARV cap is, make sure you know that number before you go forward. Because if that number on our participation would have exceeded that 176,250, we would have reduced that number down to it. And as we go through this, we'll explain some of the reasons of why an ARV cap exists and why it should be as important to you as it is to us. So what do you need to do in this deal? If we're putting up 126,000 to buy it for 140, you'll need 28 for your portion of the down payment. You won't need anything on the improvements. We're going to cover that. We talked to, there's always carrying costs on a loan. Even if you pay cash for a property, you're still going to have costs, closing costs. You won't have interest payments, but you'll have closing costs. So we estimate on this deal that there's going to be about $9,100 in interest. You're going to have closing costs between $7,500 and $8,000. And so that's going to go on your side of the table. So in that deal, you're going to, you're up to about $30,000. $31,000 is your contribution into this deal so far. But don't forget, we talked about that cost that is incurred. It doesn't cost you in cash. You don't have to write a check for it. But when you sell the home, it's going to come right off your gross profit and take away from what you have left. And that's your cost to sell the property. So that all told, your carrying cost on the deal from the time you close till the time you sell it is going to be about $30,000. So with an ARV of 235, less cost of 209,456, and where I got the 209,456, I took the 180 to buy it and improve it, and I took the carrying costs of 29,456. That's 209,456. If you sold it for 235, when all said and done, you pull out 25,000 and change as your gross profit, and you would have put just about 31,000 into the deal. So you would get your 31 back when you sold it, plus you would walk away with an additional 25. That's a pretty high return on investment, cash on cash. That puts you more in the 80% range on return. And so I don't know if you noticed this, but as we went through the three different scenarios, your return is about the same. Your return, your dollar amount on return isn't that different. The difference is how much you have to put into the deal. And the less you have to put into the deal, the higher your return is on a deal. And you know, that dynamic that you see by having to put less into the same deal, bringing out about the same return in a dollar amount, really greatly increases your cash on cash return on investment. And that dynamic right there is the linchpin of why using financial leverage is a really good way to increase your profits. Any questions on this part? We covered a lot of material really quick, so you know, if you have a question, this is a good place to stop and bring them up. Hey, Mike, I can't hear you. Let me unmute you here. Go ahead, you can unmute yourself.
Said, hey, Lee, how are you? Sorry I'm late to the call. Had some other business to take care of, but nice to be here. And hello, everyone.
Glad you can join us. Mike is a client of ours. We've done a couple of deals with him, and he came to our very first meetup we did on this subject last year, right?
Yes.
Winter Park Library.
Right. That's a good refresher.
Nobody have any questions so far? Everybody good? Let me get back to it here. Well, I think before I do that, okay. Zoom always tilts me right here, and it is the screen share part. There we go. So this last part here is on leverage, and I'm going to pass this to Lila to talk a bit about leverage and some of the other values that we add working together. I think you're muted, Lila.
Right. There we go. Okay. Technical difficulties. Okay, so in this part, we're going to see that we have an example of, we're going to show one home, if you're purchasing one flip, right? And you're purchasing at the 180,000, and you're going to see a return of 21.10%, and you're going to see a profit of $37,980. Now, if you were to use financing, you would see that you would be able to leverage your funds and be able to do 4 flips, okay? So 4 flips would gain you at 82.49%. You would have a profit margin of 148,482. So you can clearly see by leveraging your funds, it allows you to be able to purchase more homes and gain more net profit. You know, in leveraging, they're also, in dealing with a lender and being able to finance, you're going to see that we also add a lot of different value. The financial leverage here in this particular graph, you can see clearly that 82.49 percent here, that the leveraging on financing is much greater than if you were to use your own money, right, at a 17.20% gain, or at using a partner or a private investor or hard money at 26.5. So it's kind of like, it's very clear that, you're able to use more leverage and gain more net profit that way. One of the things that, that I was going over on some of our presentations and even with Lee is the added value that sometimes we don't see, right? Because as a new investor, one of the things that we do require, like we're going to require an appraisal, right? We're going to require the appraisal to make sure that if you estimated your ARV at a certain target point, that what you're estimating is achievable. It's not like you're just pulling the numbers and you're looking at some comps and you're thinking that you're going to get there. We're actually going to review, the appraiser is going to review that. And if your comps or if your estimate is not on target where it should be, like you would want to know that from the very beginning of the deal, as opposed to purchasing the home, putting all the reno into it, and then trying to sell it and realizing that, you were off on that ARV. It's kind of like a security when you think about it. The other component is, when we also look at the budget, you put a budget together, and one of the budgeting is one of the hard things in the very beginning as you're starting to flip. You're looking and you're putting all these estimates together of what it should be. But when we require a budget, we're going to require that you flush the budget out. And what that makes you do is actually think about how much money you're putting into this project. And are you hitting, your net income that you want to receive after you sell the property? So example, if you're just putting down that you're going to spend, $15,000 in the kitchen and you list that as a budget item, you're going to have to break that down. You're going to have to actually put how much you're allocating towards cabinets, not just cabinets, but what kind of cabinets. If you're putting in appliances, you're not just going to be able to say, for example, oh, I'm going to, put a refrigerator and a range. You're going to have to actually, state if it's going to be a stainless steel suite or not. So these are type of things that when you're actually doing this type of work to get the loan approved so we could approve you, you're actually stopping to think what this project is really going to entail. And it makes you also look at your numbers tighter, right? Because if your budget is exceeding, now as you start to flush this budget out, and if your numbers are exceeding what the projected amount is, then we're going to come back and say, hey, you know what, you're over the budget, and based on what you want to, lend on, the numbers are just not coming together. And so what does that do for you? That makes you really stop and think, am I hitting this target? Do I need to rethink this deal? Do I need to maybe I'm over improving this home and I need to scale back so that I can make my market? So that's an added value in terms of knowing that's kind of like, we have your back here. We also counsel you. We also, act as a coach and a mentor as, you're going through this process. And then the other part of the leverage is for those experienced buyers, right? You're actually able to leverage in terms of being able to purchase more, not just one home, but you can go out there and maybe purchase, quite a few homes at the same time and have projects going on simultaneously. So those are some of the things that, to really consider why it's so advantageous to actually finance your deal versus using cash money or a private lender, because they're not going to look at the deal the way we do.
I think one of the points Lila brought up there is important, that no matter what stage you are in your flipping career, we don't bring the same value we bring different value at different stages. If you're new, we're there to walk you through the deal, to make sure all the numbers work, to be that coach, to be that mentor, to help you understand the importance of budgeting. We actually give you budget worksheets that will help you flesh all that stuff out so that but then you move on and become experienced. And if you're doing this as a career, if you're going to make your living fixing and flipping properties, I think one of the greater values that we add is we're not a private lender. We don't have a small ceiling on how much we can put out at a time. We can do 4, 5, 6 deals with you at a time. You can have deals going on in different stages. And I think some of the real power there is that when you're running a crew, if you've got 3 homes or 4 homes in different stages, you've got work lined up for that crew. You're probably going to get a better price, a better quote. If they know that when you call, that there's real work there, and that you've got the funds to do those kind of transactions. The more deals you can do in a year, the more you can roll your money over. That's the real secret to making money in flipping. It's how many times can I roll this same money over in a 1-year period? That's exactly the way banks make money, right? They take it in and they loan it out over and over again, and keep making more and more money on it. So it compounds your ability to make money. When you buy materials, if you're able to go in and say, hey, I've got 4 properties, I'm going to need this many square feet of lumber, I'm going to need this many square yards of carpet. I guess they do carpet now in feet, right? Now that the cost has got so much higher. I'm going to buy cabinets for 4 kitchens, not cabinets for 1 kitchen. You're going to get a better price. They're going to take your call faster. They're going to respond to you faster. And so the ability to have the funds that you need when you need it is one of, I think, the big value we add once you become an experienced flipper. So we're there for you when you're starting. Here's a good example. I just locked a loan yesterday for a client. I met him at a CFRI meeting over 2 years ago. I've probably done 15 quotes for him on price quotes. We've done 7 or 8, maybe 10 workouts on deals. He's finally closing his first one. We've hung in there with him all the way through. He has that education now. Even though those deals didn't go through, that's education. You learn as much from the ones that don't work, sometimes more from the ones that do work. So we're there with you at that beginning part, and then we're there with you as you grow and build. It becomes, we're there with you for a different reason, but we're there with you.
Yeah.
Let me say something.
I just want to add.
Go ahead.
Go ahead, Lee.
I was going to say something about the ROI percentages we're giving you. These are rough estimates. You might be making a little more, a little less cash your own money. You may be making a little more, a little less partner investor, and you might be making a little more, a little less our way. Think what happens on that 235 ARV if you sold it for 242. There's $7 more grand that goes to your side, but just on the flip side of that, what if you had to sell it for 7,000 less? On your own money, that's a thin margin. 20, 22, 24% is thin. That could be the difference between profit and loss. With a partner investor, that 26% is the worst it would be if you had to split your profit. It would be double that if you just had to pay the private investor. But still, if you had to give up another 7,500, that's a big whack. I think one of the real benefits of our type of leverage is you have more room there for error on your sale price. Just like all this COVID stuff that happened, that had to affect somebody. We had loans ready to fund that we couldn't fund because of it. One of the guys on the call, that happened to him. We had a loan, we were ready to go. We were ready, and I think we had to stop, if I'm not mistaken. I think we stopped your loan the day the appraiser was going to come out, and so we were able to stop it right then. But we had 3 other transactions that they had already paid for appraisals, everything else. COVID happened, act of God, everything stopped. All lending stopped in this sector. So you have more room for margin on this type of lending than you do the other ways. I think that's one of the strongest values of it. Did you have something, Lila, you were going to say? Because I interrupted you just so we both started talking at the same time.
Oh, yeah. No, I was just going to add again to the value part and give the example, of today, that there was an appraisal that came back and the home was in the flood zone. So therefore, a flood elevation was required. And in doing so, getting the quotes back were extremely high. And what did that mean? Even though the investor can go ahead and pay for the flood insurance to get the, the project going, and they can, think they're going to bow out of this, right? They still have to sell that home to somebody, right? That's the end goal, selling the home. And if you're going to have a flood insurance that's going to require $500 or more a month, guess what? Your buyer is probably not going to buy that property. They're going to move on to another property. So where does that put you at as an investor? You just got stuck with that house. Now you got to figure out how to either refinance that loan, hold on to it. Maybe you might need to rent it, or you're going to have a lot of holding costs involved until you could find a buyer to sell that home to. And then you have to know your market, right? Who's that buyer in that particular community, that particular area? Are they FHA buyers? Are they, conventional buyers with, low down payments? $500 a month is going to make a significant difference to them qualifying for a home. So they're going to move on to something else. So again, these are things that get flushed out in the process, and bring, the information, the numbers to light that you need to know if you want to move on with those, the projects. So it's a great added value that's being offered when you do financing like this.
Let me open it up a little bit here, and those of you that have some experience doing this, were we in the ballpark on the estimates on using your own money and using a partner, or were we way off from your experience?
For me, I'm a private money lender, and you were in the ballpark.
Okay.
Y'all was right in the ballpark, so y'all good.
Good.
Yeah, I would say the same thing. Like the numbers are actually, I'm pretty sure
Okay.
I had at least one house where it was almost exactly my numbers.
Okay. Look, we're here as a lender, and we obviously want your business, but Yvonne, thanks for letting us know you are a private investor. There's a time and place for everybody. There's a time when it's best for you to use your own money. There's a time when you need to call Yvonne and get the money to do the deal. And there's a time when we're the good option for you. And so hopefully the education, the information we're sharing will help you be able to make that determination of when it is best. Because no one way is the best way for everybody. There are times when I'll tell somebody, hey, you need to find a private investor. This isn't our deal. It's not a deal that's good for us. And, maybe let me try to give you some names and numbers if you don't have those names and numbers. What
I tell a lot of my clients is, I tell them you can start with me, but try to get your credit right so you can go to somebody like you. Because you can sometimes you get a better interest rate if they go to a mortgage broker. So I said the game plan, you might have to start with OPM, but try to go to, get everything right. Get your credit right, save your money, do what you need to do so you can go to a conventional finance place because it'll be a whole lot cheaper on the money for you. So I try to tell them they need to go. That should be their ultimate goal.
Well, and that's I applaud you for giving people that advice, because some people won't. They won't.
Right,
They'll tell you there is no other option, right? We're it.
Nope.
Yeah.
I tell them,
You got to have a conscience in this business.
Yeah.
You got to
You got to help people.
And that comes back to you.
Absolutely, Yvonne.
That comes back to you. Anybody else? We're just about wrapped up here, so bear with us just for a second here. Let me cover one or two other quick things. And what we covered today is there was one part we didn't get to cover. We didn't talk about the market. We talked about what a fix and flip is, the basic definition, short-term bridge loan to buy and renovate a property to either fix and sell, or fix and keep and turn it into a rental. We covered the basic lending terms that you got to know. We took that deal and broke it down 3 different ways to show you the different options available to you in the marketplace. And then we talked a lot about return on investment and leverage. The market, most of these presentations we've done, we've given a lot of stats on where the market's been for the last 20 years in flipping. We didn't do it this time because nobody has done any stats since March. And that's all pre-COVID stats, and that's useless now. That changed everything. In the last 3 or 4 years before COVID, the return on investment for flippers has been decreasing. Just every quarter of the year, it has been inching down from the highs that it was 3 or 4 years ago to the great ones 8 or 9 years ago. And the cost of property is increasing. We all know that. When was the last time you saw a good $40,000 deal in Orlando? We had them here for a while. I mean, you could rock it in the $40,000 and $60,000, $70,000 range. Most of those are gone, and if they're there, you found the rarity, you found the gem. I have clients that are from Miami that are now doing business in Alabama. And why? Not because they like driving to Alabama from Miami. That's a heck of a drive. They're doing it because that's where the profit is. One of the things that we do is we do business in 40 states. This program we can do in just about every state other than California, Oregon, and I think there's 2 other states we're not active in. We don't do business in Alaska. We do business in Hawaii if you want to do a working vacation. And we might go there to do an inspection with you. This is a series of workshops that we're doing. This is the first one, fix and flip financing terms and how they work. The next one we're working on is, the bones of it, the meat and potatoes of it. The cost, the work you're going to do, the scope of work, the cost breakdown, the renovation estimates, the draw schedules. And so that one's going to be built around these next 2 screenshots, primarily this one. This is really 2 different worksheets that we've put together in one screenshot. On the left here, this is a renovation budget that we have. And this is an interactive budget. This is about 1/10 of what the budget looks like. On the left here, we cover every area of the property and try to break down every possible thing that you could do on that project. You can, and I have used this on ground up construction lending. I started in construction lending in '95. If you're a long-term Orlando resident, you might remember a company called Transland Financial. I was in senior management there. I ran both their retail and wholesale divisions at different times. And we did business in 40 states. We had 80 retail offices. We were the largest privately held construction lender in the country. We were headquartered in Maitland. This is based off the budgets that we had builders give us when they were, we did spec homes. One of our big deals was we did spec homes for builders. If you've ever gone to a bank to get a loan on a spec home that's not going to be your primary home, they want your first, second, and third born and a deed on your home and the titles to your cars to give you those loans. And so that was a huge profit center for us. And so a lot of this is where we've carried this over from. Everything that you put on the budget then carries over to this second on the right-hand side of the screen. Like if you look at the floor here, where we've estimated $9,000 for flooring, that carried over, and then you see where the draw schedules are. You see in this one, we estimated we've already paid, or we're going to pay on the 5th, $1,000 against the $2,000 we're going to spend for flooring. We're going to put up $2,000 against the $7,000 we're going to do for carpet. You carry it over to the right. Total to date, $1,000. Balance to finish, $1,000. Total to date on the carpet, $2,000. Balance to finish, $5,000. And down at the bottom, you see a full running total of everything you do. The more planning you do, the more you know the scope of work, the more you've fleshed it out, the better chances you have of making money and not wasting money. And so that's what this second workshop is all built around. Then we take it to something very similar to the screen you saw where we showed you using leverage, how you make money. All those numbers in the budget and in the draw schedule carry over to this worksheet, which allows you with just 2 or 3 bits of information to keep track of your numbers. You know what your rate, what your points are, what the ARV is, what your costs are, how much we're contributing to make sure you haven't. We keep a total up here to show you how much overage you still have in your ARV cap, how many months interest, and it keeps you a running total to show you what your gross profit should be on that deal. And that's our next workshop. This is really planned to be a 3-workshop series. And so this was the first one. The scope of work and the budget will be the second one. And then the third one, we're going to get together some people with a lot of experience in the different sectors, and then just go through and break it down and do a lot of questions and answers. So let me see if I can get the next screen to move forward. So if you have any questions and you didn't get a chance to ask them, or if you're like me, you think of things the next day, you can always reach out to us through the meetup group. Just go to the group and send us an email or a text. You can email both either Lila or myself. There's our email addresses. It's lila@radarmortgage.com or lee.walsh@radarmortgage.com. You can also visit our website, which is radarlending.com. We have 2 websites. Radarlending.com is for our renovation loans, our commercial lending, our investment property lending. And then we have radarmortgage.com. We also do Fannie, Freddie, FHA, VA, all the acronyms, primary purchase homes. We do that type of lending also. This is mine and Lila's favorite part of what we do. This is more fun for us, but we do those loans. We do them well. I think a good way to look at us that a lot of people don't that are involved in flipping, if you've got a flip and you've got it done and you want to sell it, and somebody makes you an offer and they want to put a contract in on it, I would never take that property off the market unless you have the buyers pre-approved, and we'll do that for you. If you're selling a home to somebody and it's going to be their primary home or investment home, if they're not already pre-approved, I would always ask that question first before you accept that offer. And if they say no, then say, hey, here's somebody that'll take care of you today. Call them. They will call us and let us know that you're approved, and we'll accept your offer. We do that a lot. I would say 80–90% of the purchase money we get on primary homes comes from realtors that we've worked with before and renovators and flippers selling property. We do very little advertising. If you would like some screenshots of the presentation we just did, if you would like a condensed version of it, just shoot either one of us an email or contact us through Meetup. We'd be glad to send it to you, or just hit the website and just reach out to us that way. I hope you learned something here. Again, if you got that one bit of information, we feel we've been successful. If you got more than one, we're happy as we can be. And hopefully we've made a friend or two on this meeting. Really appreciate you all joining us. And is there any questions, anything we didn't cover, anything you wanted to ask more questions on? Let me give you that opportunity before I say goodbye.
I've got a quick one if you don't mind.
Yeah.
As far as your flip lending package, what's your origination fee on top of the monthly interest rate?
We're generally 1.75 to 3 points, depending on the deal.
Okay.
3 is the max. I've never seen us go over 3. You're probably closer to 2.5. If it's a really small deal, it's going to be 3. If it's a much larger deal, it's probably going to be closer to 2. And sometimes it depends on the scope of the work. If we're doing really heavy renovation, it's probably going to be, it's all those things combined. Your experience. That leads me to a good question. Did I answer that?
Yes.
Okay. That leads me to something else. Is what do we call experience? We've said that a lot. It depends on your experience, your credit. Our minimum credit score is 650. We do have programs below that, but you know, we don't do that as a lender. This is what we do as a lender. One of the things we do is we'll both broker or lend. If we can't do it as a lender, but we know where we can do it as a broker, we'll broker the deal. We'd rather do the deal for you and not be able to brag, hey, we did it as a lender, and help you get the deal done. You know, because if we got the deal done, you'll remember us and come back. So we're not that proud to say, hey, we only do deals that we do as a lender. We don't. You know, I brokered a $750,000 construction loan last year. It was a loan I couldn't do at the time as a lender. I could do that loan now. I couldn't then. My warehouse facility wouldn't let me do that loan. So I found a construction lender that would do a spec home construction. It was a home in Windermere. I mean, it was a no-brainer. It was a $750,000 loan, but it appraised at 1.4. I mean, that's 50% loan to value. You know, here's how we look at experience. Anything less than what we call a 3 is an entry level. That's new. Here's what we count in numbers. If you have done 3 flips in the last 3 years, that's 3. If you own 2 rentals and have done a flip, that's 3. If you own 3 rentals, that's 3. Because if you own rental property, you know what renovation is because you've had to renovate something you own at some point. So we consider that experience. If you're a licensed realtor and own 2 rentals, that's 3. So we count being a licensed realtor. We also count being a GC if you have a GC license. So if you've got a GC license, you've got a real estate license, and you own a rental, that's 3. You pretty much have to be at that 3 mark to get 90% of purchase and 100% of acquisition. You know, if you have less than 3, we might cut it down to 80 or 85 of acquisition and 85 or 90 of renovation. We're still going to come pretty close to covering the whole deal. The deal that we went through was a real deal that we've done as a lender, and we showed we did 90% of purchase and 100% of improvements. When you look at how much cash we put into the deal, we financed 92% of that deal. That 90 of acquisition and 100 of renovation came out to, when you did the math on the numbers, came out to just a little over, we funded 92% of that total deal. And that's our average deal. Anybody else have any questions?
When's your next meeting?
Thank you, Mike. We would like to do the renovation part in about 3 to 4 weeks, the budget part, because we've done 3 of this one. In fact, Mike, you and Lila came to that same first one. We did one last year, maybe what, September, October of last year. We did at the Winter Park Library. We did 2 there. So the last one we did, almost everybody had trouble getting on. So this one is kind of a do-over for the people that couldn't get on the call. So in about 3 to 4 weeks, we will have the renovation portion. And then about 3 to 4 weeks after that one, we'll do the third one with as many experts in all the key areas as we can get on the call. We also, I believe we did one last night, basically the same workshop we did for the West Volusia Real Estate Investors Group over in Volusia County, Harlan and John and those guys. That is on YouTube. If you missed part of this or weren't able to get the whole thing or want to go over it again, you know, we didn't say do it exactly the same. You never do the same presentation the same way twice. But we were pretty close. If you're interested and want to see that one, just drop us a line and we'll send you the link for that. Or you could go to West Volusia Real Estate Investment Group on Facebook. They don't have a website, but they have a Facebook group. Good group of people. If you're in that part of the state and looking for an investment group to join, I highly recommend them. Harlan Merriman, John Veach, and several other people are the managers of it, and they do a heck of a job. A really strong group of investors. I appreciate everybody coming and joining us. I appreciate your time. It's it's an evening. I probably interrupted your dinner or delayed it, or like a couple people in the meeting last night, they had dinner while we did the meeting. That's okay too. That's the nice thing about working from home, right? If nobody else has any other questions, that's our meeting. We truly appreciate you guys and look forward to meeting you sometime in person.
Thank you,
for
Lee.
your time.
Absolutely.
Thank you.
Thank you all very
Nice
much.
having you.
Take care.
Bye-bye.